Good afternoon. Thank you for joining us today for Surge Energy's Q3 highlights and operational update. Surge Energy trades under the ticker symbol SGY on the TSX and ZTPAF on the OTC. With us today from the company are President and CEO Paul Colborne and CFO Jared Ducs. Initially, we'll touch on the Q3 milestones, then discuss your stellar drilling results and what the next few quarters will bring on that front. And as always, the presentation may contain forward-looking statements. Welcome, Jared and Paul, and congratulations on your successful convert deal, which was 3 times oversubscribed.
Yeah, thank you very much. Appreciate the intro, Jess, and we'll be really quick. I'm Paul. This is Jared. Surge just put out a almost industry-leading third quarter here. We thought our cash flow would be around 78, 79 million. It came in at 87 million. We had free cash flow on the 87 million at 40 million, so about 46% of free cash flow on the quarter. Thought we'd reduce our net debt. That's one of our key things this year, is reducing our debt that we took on by the Enerplus assets about a year ago. And we thought we didn't bring the debt down 18 million. We brought it down 25.5. Paid our capital program and a nice juicy dividend of about 5.5% on today's stock price. And then, as Jess said, we closed a really oversubscribed, nice convert deal. So I had several people, including Eric Nuttall's firm, ask me, well, why'd you guys do that? And I said, because we can. Days like this in the market make you realize you raise capital when you don't need it. We didn't have to do it. We're going to have zero bank debt on our main credit facility here soon, but we have our other convert coming due in June of next year. So we just thought we'll take it out early. Very oversubscribed deal and closed that already.
And also on the coupon on that was close to what you're paying on your bank.
That's right. Yeah, exactly. And the strike price is a 40% premium. Yep, exactly. So great quarter for Surge. Very well liked in the market. We had 9 analysts, are recommending us as one of their top oil picks in the country. Why? Why are we able to do this? As you guys know, last year we were one of the top performers with a TSR, total shareholder return of 112%. And this year you see this kind of a quarter. Why? Why is Surge able to do that? I'd love to say it's me and Jared and how great we are and good looking and nice. It's quality assets. Top assets drive top financial results. It kind of makes sense. And they deliver net asset value and free cash flow. So net asset value wise, you guys know this, but last year we're the top, I think it's the top performance of any oil company in Canada. It's a really big year if you can grow your PDP NAV 20%, because that's blow the company down, never drill another well. It just doesn't change that much. So our PDP net asset value per share went up 107% in 1 year. Never actually had that in any company I've run. It's peer leading and exciting. So you get that point. Then this one is the free cash flow yield. We have one of the best free cash flow yields in all of Canada. And what that means, call it earnings, if you will. That's what's left over after your costs of production. And it takes into account your declines. We have one of the lowest netbacks. We have one of the highest production efficiencies. We have some of the best in all of North America. My favorite slide here is this slide. A few weeks ago, National Bank put this out and said, if crude runs, who's the number one performer in the space in Canada likely to be? Because of the torque to oil, Surge Energy. This is a National Bank study. This is our guidance for the year. Our quarter was bang on this number. 335 million of cash flow at $80 oil was our assumption. Oil was about 82 in the quarter. Our production was a little below 25,000 because we were coming out of a Q2 where we had 13 turnarounds. And we're currently producing over 25,000 last week production. So we're right on track to meet or beat that. So you can just see these numbers were bang on. And that's 160 million of free cash and a capital program of 175. So our dividend's about 50 million bucks. So you can see here as we hit our next step target coming up, we will be in a position to bump our dividend 100%. We won't, but Jared will show you the shareholder return slide.
Yeah, exactly. So I'll just touch on that here briefly. Surge, as we released in our Q3 press release, is very close to achieving our phase 2 net debt target of $250 million, as you can see in the middle on this chart. At that point, as Paul referenced, we go from putting out 25% of our free cash to direct shareholder returns to up to 50% going to direct shareholder returns. So what does that look like? What does that mean for Surge shareholders? Well, as you can see on our budget price here, $160 million of free cash flow, as Paul alluded to, we're only paying out $48 million of that right now. So when we think about 50% of the 160, there's going to be another $32 million of incremental additive free cash flow to go out to shareholders. Well, to put that in a per share construct, that's another 32 cents a share going directly to shareholders, in addition to the 48-cent cash dividend we pay monthly. That's an annual amount that we pay monthly. So there's a big increase coming to shareholders here in the coming quarters in terms of potential for increases to the base dividend, starting our share buyback, getting our NCIB in place. Potential for even further debt reduction, M&A, and a growth wedge. There's a lot of ways we'll put that money back in our shareholders' hands. But in terms of the direct returns to shareholders, base dividend increases, buybacks, and if crude spikes, even the potential for special dividends.
The macro, I won't belabor too much. I think it's an absolute powder keg now, and I have no idea why crude is down today, but it is. But if you look at it, I think we've been underinvesting for coming up 8 years, and it's so exciting for a crude oil producer like Surge. We're 87% light and medium gravity crude, so we have some of the best torque of any company in Canada. Our cash flows with a crude oil price spike. This is a real cool slide put out by 9 Point Partners, Eric Nuttall's firm, just showing how valuable energy. It's underweight and low, trading at low multiples vis-a-vis historical, but yielding some of the best cash flows and returns of any sector in the world. And it's hilarious. Investors are so excited to buy AI stocks or, Google or whatever they're buying, that, and even stocks, if they're not even cash flowing, when energy is the one that's delivering the bulk of the returns from a cash flow perspective. So we like that, especially in our dividend model. I'm going to just keep spewing out cash tax effectively to our shareholders. What's wrong with that?
Well, and no one's buying EVs. I mean, they're all going to shit. So I don't understand why, people aren't waking up a little bit more to what.
Yeah, we're told,
especially after Europe and everything else. I mean, it's I just don't understand why still we haven't seen more money flow into the sector.
Yeah, I agree with you. And when you hear that Ford is losing $70,000 per EV, how long can that continue?
Yeah.
I bragged a lot about our asset quality. I said that's responsible for us to continuing to deliver these great quarters. This chart is a simple reason why, if you look at this. Quality of rock, permeability along the bottom, 0.1 mil at RC, and tighter rock on the left. Deep, expensive, tight reservoirs with huge costs, huge fracs, huge declines that don't water flood. Wildly underperform versus shallow, conventional, low-cost reservoirs, low declines, the water flood. That's it. There isn't some other special secret sauce. And it makes sense. The quality of the reservoirs should drive the financial results. And above the line there, you see the financial side. The profit to investment ratio goes through the roof. That means the amount of times you got your money back on your investment. Some of our floods, we're going to get 8-10 times our money back under water flood over the years, and our internal rates of return. So that is Surge. We're not the deep, sexy, expensive, tight rock with huge costs, huge fracs. We'll leave that for other companies. We're the low-risk, conventional water floods that keep delivering for years more oil than you'd ever thought you'd get out of the reservoir. Jared's good on this slide. So that was a nice pictorial. He's going to try and show you empirically along the bottom row the hidden value that means you get as a shareholder of Surge. Jared?
Yeah, so there's a lot of numbers on this slide. So what I direct you to is the bottom row here. Under Surge's land, we own and control over 3 billion barrels of net original oil in place. And we only book about 490 drilling locations. So in that proved plus probable net asset value of over $22 a share that we talked about earlier, we only book less than half of our drilling locations. So 489 of the well over 1,000 identified drilling locations we have in the company. So, well, what does that mean to a Surge shareholder? Well, when you have this much oil in place, getting just a small amount more out of the ground drives outsized financial results. So 3 billion barrels, if we just take this 7.7% of the oil under the ground we've got out and take it to 8.7%, what is that going to do? Well, when our water floods, we can get 20, 30% plus of the original oil out of the ground over time, as Paul alluded to. But what if we just get 1% more out, go to 8.7% recovery factor? Well, on 3 billion barrels in place, that's 30 million more barrels out of the ground, put a $40 net back on that. That's $1.2 billion of incremental undiscounted cash flow to our shareholders. For context, that's practically our enterprise value today. So there's an incredible value in unlocking just small changes in recovery factor, getting a little bit more out on a percentage basis when you control large oil in place reservoirs.
So if you just one quick back there. So it sounds crazy when you say, why does Surge have such a good P plus P, proved plus probable net? Well, that $22 net asset value, Sproul is only letting us produce out an 11.5% recovery factor. As Jared said, we hope to get to 20, 25%, maybe even 30 under some of our pools and water flood. So that would be way more than the $22 net asset value. Sproul just draws the line there. So to his point, it just shows you the hidden value you get from these elite conventional reservoirs. And you don't get it in 1 year. Nicely, you get it spread out. You know what this 7.7% recovery factor said a year ago? 6.5. So we had a really good year, and it's nice to know you're going to get those reserves out over time, and they are what help keep your finding costs low. As a reservoir, we call them recovery factor barrels. They're almost for free, and that's the reservoir outperforming the Sproul report year after year after year. So we think this is lost in a lot of the current valuations. Young analysts don't risk adjust the profile of Surge as one of the lowest risk, best value stories.
So we'll chat for just a few moments here about our assets here at Surge. As we'll show you, we have two of the top plays in North America for oil plays. We'll walk you through some of that independent analysis. But critically, it's important to know that over 80% of our production exit this year is going to come from two of the top oil plays in North America. And that's where we're focusing our capital. Over 90% of our capital is going into the Sparky and Southeast Saskatchewan areas. And why? Because, as I said, Peters & Co., National Bank, Raymond James, others have all listed Surge's Frobisher and Sparky horizontal wells in the medium and light window as some of the best oil plays in North America. You can see here, this is ranked on payout. Our Sparky sits there right behind the Charlie Lake, our Frobisher right there nipping on the heels of the Clearwater. And we'll chat about the impact of water flood there in a moment. Critically, we have a dominant operating position in these two plays. 75% of those over 1,000 drilling locations I referenced are in the Sparky, are in Southeast Saskatchewan. So we've got a great 12-year runway in the Sparky, as an example, to drill some of the best wells in North America. And that's really that asset distinction Paul talked about.
So I'll touch on the Sparky. Jared can have Southeast Sask. This is an 11 billion barrel play trend found in 1922. You see Edmonton straight south on the map there is Calgary. We said on the 11 billion barrels, 7 billion is in the heavy weigh we said we can't really go in there and compete with Husky, Sonova, CNRL, Imperial Oil, Baytex, now Strathcona. We are going to stay in the light and medium window. So we made this decision consciously about 10 years ago. So 10 years ago, we're zero. Today, we're 12,000 barrels a day in this light and medium gravity window. We've accumulated, there's 4 billion barrels of the 11 is in this light and medium window. We now control and own 1 billion barrels of that. It's an unbelievable position we put together. We've gone from zero to almost 12,000 barrels. Next year, we hope to exit above 12,000. 1 billion barrels captured in place, a low recovery factor. We've drilled 230 good wells in a row. few little tuck-in acquisitions, but largely organic. And we have 480 more lokes on the books. Water floods like a dream. And, we're talking almost 200 million of cash flow from this asset. It's become one of the dominant plays in Canada and a dominant position on the play. And the Manville has become shockingly sexy after years. And I think it's technology, but now we've got the horizontal multi-frac. We've got multilaterals that people are drilling. So if you go back one slide, Jared's going to show you a new play. We've used Clearwater technology, gone a tad heavier. Our corporate gravity is around 23, 24 API on the 11, 12,000 barrels. We're going to go a little bit heavier, not into the goo, not the 12, 11, 10 API stuff to the north where Husky is and Synovus and CNRL. Just slightly heavier using multilats.
Yeah, so hopefully what you can see on this is that lighter gray dash line that we call the halo of our Sparky play. To Paul's point, this is where we're going after high teens, low 20 degree API crude. We put together an over 20 section land block here that we call Hope Valley. Drilled a couple good initial delineation wells into there. We're now shooting a large 46 square kilometer 3D seismic program here right now. We're going to interpret it over December and look to be back drilling some more of those exciting 8 to 12 leg multilateral open hole wells into that broader area here early next year. So that's really an exciting development for us. We've drilled about 17 of these multilateral wells, had great success, and not just up here in this recent Hope Valley area. We've been having great success down in Macklin, in our Betty Lake areas, drilling some great wells. So we're using that technology, to Paul's point, to just push the boundaries into the halo where these wells still get great netbacks, they produce conventionally, and we don't have sand issues that you would have more typically up in the CHOPS production that Paul referenced. So really excited to continue pushing the Sparky, taking our dominant operational position here, our 10 years of experience, and grow the Sparky even more.
Could I ask a quick question while we're on the Sparky? Obviously, this is a play that no one talked about for years, and because you guys controlled it. Now, initially, you were doing single leg laterals to complete. Now, on the medium light window, you're now doing multi leg completions. I think on some, and then single leg on some. Is that correct?
Yeah. Sorry, go ahead, Jess.
I was just going to say, does it vary from area within the area? What kind, and whether or not if you're on a water floodable section, etc. What completion, drilling completion you're doing?
You're right. I think the best way to think about going from the single leg fracked wells that we have drilled the bulk of the Sparky with to the multilateral open holes, it's another tool in a toolkit. So to your point, we're still developing the majority of the Sparky with the single leg frac wells where we've got a couple different sands that we're trying to interconnect. But what the multilateral development, let the guys in the Clearwater spend all the money on the science with the mud systems. Now we're the benefactor of that. What that allows us to do is in situations where there's bottom water, we can avoid that. You don't frack into the ocean, as it were. In areas where things are a little heavier or we've got one sand, we can go in and use the multilaterals. So it really is geologically driven, case by case basis. Another good example where we have land access issues. We have a great pool at Betty Lake. Just offsetting a military base. Well, instead of spending all the money to operate and drill on the base, we can simply sit off the base and drill under with these multilaterals. A lot of great different use cases for this technology, but from Surge's perspective, it really is just another tool in the toolkit that lets us further develop the Sparky.
Okay, excellent answer. And just on the heavier window, I know you've done between 6 and 12 leg, multi-leg completions. What do you, I to talk to Murray, he thought 8 was about the right number. Is that how you guys are still thinking about it, or are you waiting till you've done the 3D and determined then?
Yeah, it will come down to the size of the application. I think somewhere between 8 and 12 legs is where we're landing. We're also continuing to refine those mud systems. Our latest well at Betty Lake that's looking very encouraging was drilled with an amine mud system.
Okay.
We used the KCL system previously. We're going to drill our next multilateral location at that broader Hope area using the amine mud system. So we're just continuing to use the science and money spent in the Clearwater to get better and better results down here. So I think it's still a case-by-case basis, but something in the 8 to 12 legs, depending on where we're drilling, is where we're landing right now.
And the nice thing is it's consolidated in your area, so you don't have sanding issues, unlike the northern part. So.
Exactly. You're not having to run the expensive slotted liner and deal with well bores collapsing from sand, et cetera. So again, great tool for the toolkit. But the Sparky's been great for us for 10 years. Those single leg frac wells, that approach isn't going anywhere. Those allow us great water flood upside, et cetera. So it's just, like I said, another tool that's really helping us grow the Sparky.
Okay, sorry to interrupt, but I thought it was a good time to bring.
Oh, great question.
It's changed so much how you're completing things in the area, so it's exciting. Go on.
Yeah, that as Paul said, the Mannville continues to get more and more interest. It's becoming one of the hot plays, and we're able to be a beneficiary of taking some of those learnings in the Clearwater and growing the Sparky with it. So, following on the success in the Sparky, recently re-entered, 2 years ago now, back into Southeast Saskatchewan. Taken our production in this area from zero a few years ago up to over 8,000 barrels a day. From Surge's perspective, this is really a portfolio theory approach. We've got that great long life medium oil we just talked about in the Sparky. Now we're in Southeast Saskatchewan. It's light oil downstream of any Alberta pipeline issues. Some of the best netbacks in North America. That's what made Southeast Saskatchewan the place to be for the last 50, 60 plus years. And we put together a great runway here. We've got over 400 million barrels of net original oil in place under our control. We see 275 drilling locations here. To give you a context, that's an 8 to 10 year drilling inventory for us if we just stop finding new locations today, which of course we're not going to do. And critically, the results here have been peer leading. This is what drove us back into Southeast Saskatchewan. We really focused on the Frobisher and we came back in here. Great majority of our locations in Southeast Saskatchewan are Frobisher locations. And you can see the proof is in the pudding, as it were. Over the last, over the 18-month period here, January of 22 to June of 23, we looked at the initial production rates on a 90-day basis. So the first 90 days of production, looked at all the wells that all the companies that drilled Frobisher in that time period drilled. Surge drilled 42 wells, had the best average results of the entire group. 42 wells averaging about 185 barrels a day. So fabulous results. To give you some economic context for that, these wells on average at the time they were drilled were paying out in about 10 weeks. So you're getting all of your $1.2, $1.3 million drilling costs back in a matter of weeks. Those are some of the best payouts in the industry. So great payouts, great results. And that's really what focused us on getting back into Southeast Saskatchewan. And we have the depth of inventory to keep drilling those kind of wells here going forward.
Last point here, we'll just leave you with the quarter. As I said, was a blowout quarter with a 6% beat on cash flow. We're covered by 9 or 10 or 11 of the top analysts in Canada. All have Surge as their number one pick or a number one pick for oil. I think Q4 is going to be a great quarter as well. So our asset quality is just shining through here, and also the low risk nature of our assets. I know Crescent Point announced their big deal. They're now pushing all their chips into the Montney and the Duvernay. Well, that's risky. There are Plains drillers who are making a strategic move in there. I hope it works for them. You saw today, guys, Cardinal making a move into SAGD. Go ask Derek Evans, is a good friend of mine who runs MEG. That's a 15-year process, and they've spent billions of dollars, and it's a risky, capital-intensive play. So I hope it works for Cardinal. In our case, we're a low-risk conventional producer with two of the 4 best plays in North America, and we are staying focused on the bit in those areas. That's our story. Jess, you said you had a few questions for Jared or myself.
I do. I was just going to comment on the SAGD. I mean, MEG has the most perfect reservoir as well for SAGD. I mean, and that's what it comes down to, your SOR ratios.
Yeah,
and
so many dead bodies
are
lying out there trying to find the next Christina Lake. Like, trust me, there's a lot of dead bodies out there.
Yeah. Okay. Just want to touch back on the Frobisher. I mean, you keep adding locations. Some of it's because of your drilling success, and some of it's because of acquisition. I mean, you probably don't want to tell us your secret sauce as to why your drilling, your wells are so much better. But you see more.
Yes, I'll tell you. Our oil in place per section is at least 3.5 to 4 million barrels. And if you can go back and tell Cam Taylor, he's not in the top 5 on this list because if I do the work and I look at it, now he is moving up. Our guys are saying he's drilling some good Frobisher wells, but it's so important to have a sifter in your calculation and go, if it's not 3.5, 4 million barrels per section or more, don't drill it. Don't focus on it. Go tell your geos, go find me some bigger oil in place per section Frobisher. And the truth is, they will find it. They're out there to be had.
So it's just bigger bumps you're finding, basically.
Yep.
Okay.
Bigger reservoirs.
Yeah, bigger reservoirs. So you picked up a ton of land from Whitecap in that area. Is there? I'm assuming there's. Okay, I think we talked about it at lunch, but you said there's a lot of privates for sale. Would they be in the Southeast Saskatchewan area?
Yeah, so there's exactly. There's several private cos: Axial, Triland, Anova. What's the other little one that just came up for sale? So there's Adnai. There's a number of small private guys that are trying to sell the company or assets in here. And we've been looking at them and bidding on some and not bidding on others if we don't think it has the large enough oil in place per section criteria we have. So yes, there's a number of private cos, and there's even a couple in the Sparky area. Year is up for public sale through Peters & Co. And ATB has a company out for sale that's about 1,800 barrels called Ghost River. So we're looking at a lot of little private cos right now.
Okay. And anything sizable out there that's for sale that's interesting to you, or are most of them smaller?
I wouldn't say that much that's interesting to us, but when you look at Crescent Point's deal this morning, has to make you think that, okay, if they're taking on a lot more debt to the $1.9 or $1.7 billion all debt deal they did with Spartan Delta, would they part with the Shaunman? Shaunman's about 22,000 barrels a day in the Shaunman trend. They parted with North Dakota. So there is a lot of consolidation in the industry, and it's bringing opportunities, I think, to the fore right now. So we still there's lots of nice, smaller reservoirs in our core areas. Every deal doesn't have to be big or transformative. As Jared said, if we have a 10-year inventory, let's just, in some of the best plays in North America, let's just keep going, putting out good quarters, paying debt down, bumping the base dividend, share buybacks, special dividends, and even add a growth wedge. We've got all that on the horizon in the next 12 to 15 months, all of those good things.
Well, and that's one. I'll go back to M&A in just 1 second, but of your 1,000 locations, how many of those of your tier 1 locations, I think it's over 50% that pay back in less than a year? And is that correct?
That's right. Yeah, depending on price, but based on our budget pricing, you're pushing about 60% of our locations are in that tier 1, tier 2 category that pay back in a year to a year and a half or less. So, we've got an incredible depth of inventory at budget pricing. We've got an 8-year plus inventory of drilling, incredibly quick payback wells that are in that tier 1 and tier 2 category. Without going and finding another location. That's what we have a great G&G team here for. Every year they're finding as many or more locations that we drilled to replace them. But even if they stopped tomorrow and went home, we'd have an 8 to 10 year deep drilling inventory of highly economic tier 1, tier 2 looks.
And how does that compare to most that kind of to others, on a ratio basis? Like how many could say that they would have 60% of their tier 1 wells that pay back in less than a year?
I don't think there's anyone like us, because most guys, most companies that are conventional producers have 2-3 years of drilling. I was at Husky Oil for years, and we had 2 years of drilling. We were happy. To have 8, 10, 12-year drilling inventory as a conventional producer is unreal. And we're looking at peers all the time. You saw there's a reason Cardinal moved to try and get into SAGD is they've had a hard time finding locations in their core other areas. So other people make a move. Maybe a Whitecap has made a move to go into the Duvernay and the Montney, CPG the Montney. To get a low-risk conventional producer with a 10-year drilling inventory is abnormal. It's that good. And I'm glad you touched on it. It's probably one of our biggest distinguishing features, and it's on this chart, and still people gloss over it. Well, it's everything. It means we don't have to do something risky and go, flip back to one slide here, into this tighter rock, which is scary, costly, and really not our mantra. We want to be your low risk, conventional water flood producer. That's really conducive to the DivCo model, and that is our model. We're not trying to be high growth at this point. It's just not in our mantra. We want to increase your dividend and keep our production water flooded and flatter.
Okay. And would you add a growth wedge at some point?
Yeah. So go back to your shareholder return slide. So why don't you mention as we hit phase 3?
Yeah. So as we said in the release here, on the back half of next year, we anticipate hitting phase 3, getting to that terminal debt target of 175 million of net debt or below. And as you can see here inside of the 50% green section here, there's definitely a component here that we've earmarked to a growth wedge. That would likely be something in the 3 to 5% growth production per share wedge, probably starting in 3.5%, growing from there. But definitely something we're looking to add. But right now, focused on continuing to pay down the debt, increasing the base dividend, and getting the share buyback going. Get to phase 3, adding the growth wedge.
It'd be about $40 million would get us about a 3.5% growth wedge, Jess.
Okay.
So if you got 160 million of free cash flow, say we bump the base 10% is only $5 million, start a share buyback. That's where we, the key for us is, though, we've said we're in no rush. We're already going to probably hit the next debt target in late Q1, bump the dividend, the base, keep chunking it on the debt. Then all those things Jared mentioned late next year, probably have the growth wedge in the 2025 budget. Just 3.5%, but we've got so much free cash flow. The terminal debt target is the 175, so it's in range now.
Would you, given like your asset base and you're not getting full value for it at all, would you even consider doing spin-offs like of your assets?
It is something we thought. Everybody laments your stock price. We don't really. We have an okay multiple. We're 3.3 times EV to DACF. Whitecap kind of leads our group at 3.5. Some guys are at 1.7 times, a 1.9 and 2.3. But our multiple is pretty good. The point is, nobody is buying assets for high growth, steep decline assets. It's 2 times cash flow, longer life production that's splatter and maybe even water flooded is 3 times. So if we spun something out and it traded at 3.5 times, there wouldn't be a huge win.
Huge win, not like we used to get in the old days.
Yeah, exactly. So you're right. I look at it all the time, and then we break up the parts and go, Surge is, we have an upper third multiple. So it's not the lowest, but there isn't a huge win. If there was, I'd do it in a heartbeat. In a minute, I'd do it. If there was a 1, 2, 3 times multiple gain. Good question.
Yeah. Okay. Now, would you, anyone sniffing around you?
Yeah. So I got asked that on a meeting earlier today. Every day I wake up, and I think our team, and we're buyers or sellers. When you have asset quality like we do, I think Whitecap should be drooling over Surge because they're in the Cardium. They could draw a line and go take their whatever size there, but take our Sparky, and it's all central Alberta. They're in Southeast Sask, but they're selling some of their stuff. They're keeping Weyburn, but our 8,000 barrels would fit there. They're up at Valhalla where we are. So I think a Whitecap, I think a Tyne, who's made a dip into the Sparky. Strathcona could be another one. Cenovus, I cannot believe that Cenovus is not all over our Sparky because they have the Husky corridor there with the upgrader, the refinery. So I think, but we're a buyer too. We're always looking for gears up for sale. As I said, there are about 5,500 barrels selling through Peters & Co. There's other Sparky and Southeast Sask private coast. So it's a really good question. I think we have that optionality where are high quality assets people would want to buy, or we can be a consolidator ourselves.
And you have a lot of experience doing multiple deals of sizable deals. So,
I
you
think
could certainly easily manage doing something that's your size or larger and merging in.
Yeah, and the Crescent Point deal is what I mentioned is there are about 23,000 barrels in the Shaunavon. Well, that probably is on the blocks now because they're kind of all chips in this morning. Their announcement they're all chips in on the Montney. So 20,000 barrels a day in the Shaunavon has suddenly become probably non-core to them. So there's an example of, that could
something
be exactly.
Yeah.
Derek Christie ran those assets. He still thinks there's another round of drilling on them.
Well, that would be, and like you said, they could not of interest to Crescent Point anymore. So could be a perfect fit for you.
Exactly.
Okay. A couple questions from the audience. Just you get different pricing depending on your Sparky versus SE Saskatchewan. So what's your discount to WTI on either?
So I think for sure. So Southeast Saskatchewan is our light oil business unit. So broadly, there we would get WTI minus $3. For that business unit. Then the Sparky assets there are a nice medium and light stream there. So they actually get a little bit of a premium to WCS, which is Western Canadian Select. So those barrels in Sparky see a $2 to $3 uptick versus Western Canadian Select, which is the crude stream that prevails in that area. And then our northern Alberta units, Greater Sawn and Valhalla, those are again light oil. And so those assets see, from a WTI perspective, $3 or $4 discount to WTI.
Great, thank you. In the Sparky, do you have waxing issues with production? I.e., do wells producing require a lot of chemical attention?
No particular waxing issues, no sand issues. They produce conventionally, so no outsized chemical cost issues in the Sparky at all. It's great conventional light and medium crude.
Okay. And have you considered doing a dual listing, like going on to NASDAQ or New York? I know it really increases your costs on D&O, et cetera, and as well as legal.
It's something we have considered, but we'd probably do it once we're getting close. Then you get a week like the last week here where crude crashes, but with two wars going on, one in the Middle East, I still can't believe that, but we're getting close to being in the index. So once we are around, I think, $1.3 billion of market cap, $1.4 billion, somewhere in there, that's where we'd probably say, okay, does it make sense now? So that investors that when we do go market actually want to talk to us as opposed to not take the meeting or whatever. I think it's part of, quote, growing up as a company as we're a solid intermediate now on our next deal or next time crude runs, we get into the index. I think that could be the time we look at an interlist, maybe NASDAQ or London or something like that.
Okay, great. Anything new in the Midale?
We have a pool in called Bryant that we think is a really exciting Midale pool, and it's not big, but we've got it through the FireSky acquisition. We're just having great water flood results. Then we've had great drilling results. We've now bought more land. It's just a bigger pool, and we think it could be as much as a 50 million barrel in place pool. More drilling, more upside, and through water flood and infill drilling there. So that's just turned out to be, that was Steelman. The Steelman properties turned out to be just a beast. We're doing over 3,500 barrels a day. It's got about an $8 OPEX and probably a $75, $80 net back because a lot of the production is new and getting the royalty-free holiday down there. Just been an amazing asset. And it's cash flowing like crazy for us. So Saskatchewan just turning out to be a lot of fun there. Yeah, a bit higher decline. That's why we bought the long life units from Enerplus. So we brought in about 8,000 barrels, 2,000 of which don't decline. Beautiful long life water floods. They really nicely balance out the decline and get it into the 30-35% range, where if we're just drilling Frobisher wells, we'd be 40, 45, 50% decline. So it really completes the Southeast Sask business unit, the Enerplus deal.
Yeah, no, it was I mean, and you got so criticized on the Astra Fire Sky, and look how beautifully it's turned out.
They
And then
both turned out to be crazy good. Yeah.
Yeah.
I agree.
Go ahead. Sorry.
No, I was laughing at our board the other day because some of our board even has said to me, "Oh, well, we kind of needed to do that because we wanted to delever and all that." I said, "No, we like the assets." So now, a year and 2 years later, I'm kind of throwing it back in their face and teasing them a bit and going, "We are so doing well on both those transactions." And FireSky even brought us production and a second battery at Steelman, as well as the Midale water flood at Bryant. So very, very excited about Southeast Saskatchewan. Now with Crescent Point leaving, Vermilion selling assets, Whitecap has sold assets. We're in. We're the guy that wants to grow in Southeast Sask. So all these private cos, I think they're going to come to us, and then we all get a chance to look and be the clearinghouse there if they meet our asset quality requirements. I mentioned to you that oil in place per section test will be all over them.
Okay, perfect. Okay, and so just one more question. You previously said that Surge needs about $65 WTI to sustain its current dividend, and that when you reach the next debt target, the company will increase the dividend. Do you expect the dividend increase that will continue to be sustainable at 65, or will that figure?
Yeah, I think broadly that's exactly right. As we continue to pay down debt, we're reducing our interest expense, and that allows us to transition effectively what were interest payments into dividend payments. So you maintain roughly that $65 break even with the enhanced dividend into phase two, in large part due to interest savings.
I was going to ask you one thing. You did get a 1.5% increase on your recovery factor this past year on your reserve report. Do you think that could be more significant this year, or not sure?
I think it's you can't judge any 1 year, but as time ticks on a conventional asset base like ours, it's nice to know that you're getting those recovery factor barrels, and those come out through water floods, and the reservoir is doing better than Sproul thought, because Sproul always slaps a decline on you. So at the end of the year, you walk in and go, yeah, the Betty Lake, the water flood there did better than I thought, and Cadogan and the Bryant water flood and the Steelman and whatever, and you show them that it's outperforming. Those are barrels that you get that are almost for free. So then you add those into your drilling recovery factor barrels, or your drilling barrels, these free recovery factor barrels. And the only way you get them is have the huge oil in place conventional floods generally are the way to get those. And that's where, it starts to flatten out your decline. So it's worked for me forever. And that's one of the hidden values you get owning a conventional company. We're not out to get into the Duvernay. You're not going to wake up one morning and find Surge has done a $1 billion Duvernay or Montney acquisition. That's for others to do. There's so many reservoirs. We were just saying this morning, I think we could easily double the company buying other elite reservoirs that are out there. We don't need to go West 5 like some of the guys, or into the heavy oil SAGD like Cardinals announced or whatever. So yeah, we see lots of upside in our existing core areas.
Yeah, I mean, I haven't stumbled all webinar now. Here I am. But anyway, I look at what, reading through your research reports, everyone looks pretty primed to, increase their targets. It would look like, as long as we continue to have a constructive oil market, which I think we will. So
yeah, we're doing our part. We're paying the debt down, paying a base dividend, and grinding through. But as you know, last week we were already producing more than our exit rate for the year. So we have about, I think it's 15 or 18 wells more to bring on this year and early next year that, we're going to blow through 25,000. So we're ticking on all cylinders right now. And for an investor on this call or other calls, check us out. I love it. Go stack us up against anybody else in the sector. And I'm telling you, our asset quality is what drives these top financial results. This third quarter, another great example. A 6% cash flow beat across all 12 analysts, what they had for us. That's a big beat. And now production's kicking in this quarter. And no, it's quite exciting.
Nothing but good news, I would say.
You betcha. So thank you very much for your time, guys. And anytime, Jess, we love doing these. Let us know.
Okay. And if anyone needs any further information, please email me at jessica@adcap.ca. Have a great afternoon.
Thank you.